Nobody blows up a small account because the market was too hard. They blow it up because somewhere deep inside they believe one trade can fix everything. That belief is so quiet you can barely hear it. It runs underneath every decision, underneath the position sizing, underneath the stop placement, underneath the just one more try. And it is invisible until the day it isn't. Until the day the account is gone and you're sitting there trying to figure out what happened, and the honest answer is, you happened, not the market, you. I know that's uncomfortable. It was uncomfortable for me too, the first time I was willing to really look at it. Because it's so much easier to believe that the market did something to you. That volatility spiked at the wrong moment, that you had bad luck, that the setup was fine but the timing was off. All of those stories have just enough truth in them to be convincing, and they all share one thing in common. They keep the problem located somewhere outside of you, somewhere you can't fix, somewhere you don't have to take responsibility for. And as long as the problem lives out there, so does the solution, and you keep waiting for it. Here's what I want to say about small accounts specifically, because there's something about trading a small account that amplifies every psychological vulnerability a trader has. When the account is small, every loss feels enormous in percentage terms. When you lose 2% of a large account, it barely registers emotionally. When you lose 2% of a small account, it can feel like the whole thing is slipping away. And that feeling, that urgency, that low-grade panic is the exact condition in which the deepest, most dangerous belief in trading gets activated. The belief that one big trade can make up for everything. You've felt it. I know you have, because every trader has. It's the moment when the math stops making sense and the desperation starts making decisions. You weren't going to risk that much on this trade. But the last two trades lost, and this setup looks strong. And if it works, it gets it all back, and maybe a little more. And you tell yourself it's calculated risk, when really it's a prayer. And prayers aren't a trading strategy. Those are the moments, those exact moments, where accounts that were supposed to grow quietly get destroyed loudly. Now I want to tell you about the 3 rules. But before I do, I have to say something about what these rules actually are, because it's different from what most people expect when they hear that phrase. When traders hear the 3 rules Mark Douglas used to grow a small account, they imagine 3 tactical guidelines. Something about position sizing, or stop placement, or how many trades to take per week. And those things matter, but they're downstream of something much more important. The 3 rules aren't about protecting your money. They're about protecting your thinking. Because once your thinking goes, the money was already gone. This is the thing I spent years trying to get traders to understand. The rules you need to follow aren't external constraints imposed on an otherwise free mind. They are the structure that makes a free mind possible in the first place. When you have clear rules and you follow them consistently, your mind is freed from the exhausting work of making it up as you go. When you're making it up as you go, every decision requires effort and generates anxiety and costs psychological energy you don't have to spend. When you follow rules, decisions are already made. All you have to do is observe and execute. That sounds simple. It is not easy. But it is a completely different relationship with trading than the one most people have. Here is the first rule. Only risk what you could lose completely and still show up to trade tomorrow without it changing anything about how you feel or how you trade. Read that again. Not risk what you can afford to lose. Not risk 1 or 2%. Risk what you could lose and still feel exactly the same way about trading afterward. For most traders, starting with small accounts, that number is smaller than they think. Much smaller. Because most traders, when they calculate how much they can afford to lose, are doing math. And math doesn't account for how you will actually feel when the money leaves your account. It doesn't account for the thing that happens in your chest when you watch a position move against you and you know you have real money on it. Only you know what amount you can lose without it touching your psychology. That amount, whatever it is your true position size. Trade smaller than that if you're unsure. You can always size up later. You can't undo a blown account. I want to give you a practice step right here, because this rule is useless if you keep it abstract. Before your next trade, I want you to calculate your intended position size and then ask yourself one question. If this trade goes to full stop loss right now, before I even finish the sentence, before I can do anything about it, how do I feel? Sit with that for 10 seconds. If you feel your stomach tighten, if you feel a spike of alarm or dread, your position is too large. That physical response isn't weakness, it's information. It's your body telling you that you've crossed the line between calculated risk and emotional exposure. Adjust your size until that feeling goes away. When the size is right, losing the trade should feel like losing a small bet. Disappointing, but not devastating. Not even close to devastating. The second rule is this: execute the trade exactly as planned, or don't take it at all. Not almost as planned, not mostly as planned. Exactly as planned. Entry, stop, target all three, predetermined, all three honored without negotiation once the trade is live. This rule sounds simple, and it is one of the hardest things a trader ever has to do consistently. Because once you're in a trade, the emotional environment changes completely. Before the trade, you can think clearly, you can see the chart objectively, you can set a sensible stop, but once real money is on the line, a completely different part of your brain takes over. And that part of your brain has one objective: avoid the pain of loss. And it will generate extremely convincing reasons to move your stop, to hold past your target, to add to a losing position, to do all of the things that your pre-trade, clear-thinking self had already decided not to do. The only defense against that in-trade self is a rule that was made before the trade started by the version of you that could think clearly. That rule has to be treated as inviolable, not as a guideline you deviate from when the circumstances seem to justify it, because the circumstances will always seem to justify it. Your in-trade mind is very creative. It will find reasons. The rule exists precisely to override those reasons. Now, I have to tell you something I've never said in exactly this way before, and it changed everything for me when I finally admitted it to myself. There was a period in my development, a long period, when I thought I was following the rule. I thought I was executing as planned. I was setting stops. I was setting targets. And then regularly, when the trade moved against me, I would find a reason that this particular situation was different. The news just came out. The structure of the market has shifted. My read on the higher time frame changed. And I would move the stop. Just a little. Just this once. And I told myself each time that it was skillful adaptation. That I was reading the market in real time and adjusting intelligently. But here's what was actually happening. I was afraid of losing that specific trade, that specific amount of money, at that specific moment. And my mind, my very intelligent, very well-trained, very creative mind, was generating sophisticated justifications for doing what fear told it to do. And I couldn't see it. I couldn't see it for years. Because the justifications were good enough. They sounded like trading skill. They looked like experience. But underneath all of them was the same thing. I could not bear to take the loss. And so I found reasons not to. The moment I finally saw this clearly, the moment I admitted to myself that my adaptive in-trade adjustments were almost never skill and almost always fear, was the moment my trading changed, not because I became fearless, but because I stopped letting fear disguise itself as intelligence. I started asking, every time I felt the urge to adjust a trade, is this my system speaking or is this my discomfort speaking? And the answer almost every time was discomfort, so I honored the plan. The second practice step I want you to take is this. For the next 10 trades, do not adjust a single parameter once the trade is live. No stop movement, no target adjustment, no early exit unless your system explicitly allows for it. Log every trade, and after each one, write down one sentence. What did I want to do differently while I was in that trade, and what stopped me? Over 10 trades, you will have a clear map of where your psychology attacks your execution. And once you can see the pattern, you can start to work with it rather than being unconsciously controlled by it. The third rule is the one that most traders know they should follow, and almost no one actually does. Sit with the results, all of them. Don't categorize a loss as bad trading and a win as good trading. Don't reach for an explanation every time an outcome surprises you. Sit with the result, acknowledge it, log it, and leave it alone. This rule is about developing what I call result neutrality, the ability to receive any outcome from any trade without it changing your self-assessment, your confidence, your willingness to take the next trade, or your evaluation of your system. Result neutrality is the psychological equivalent of a scientist running an experiment. The scientist doesn't celebrate when the hypothesis is confirmed and fall into despair when it isn't. They observe the data, add it to the sample, and draw conclusions only after enough data has accumulated to support them. That is how you need to relate to your trades. Each trade is one data point. A single data point tells you nothing about your edge. 10 data points tell you very little. 50 trades begins to reveal a pattern. 100 trades starts to confirm or challenge your assumptions about your system. That's the time scale on which meaningful evaluation happens. And every time you evaluate a trade in isolation, every time you decide after one loss that your system is broken, or after one win that you finally figured it out, you are working against yourself at a fundamental level. Here is the third practice step, and it's the one I want you to carry with you every day. At the end of every week, count your trades and sort them into two categories. Trades where I followed my rules and trades where I didn't. Do not sort them by winners and losers. Sort them by execution quality. A trade where you followed your rules and lost is a good trade. A trade where you broke your rules and won is a bad trade. This reframe, shifting your evaluation from outcome to execution, is one of the most powerful things you can do for your long-term development, because your execution is within your control. Outcomes are not. And optimizing for the thing you control consistently over time is the mechanism by which a small account compounds. Let me bring this all together, because I want you to leave with something that is clear enough to actually use. The reason small accounts blow up isn't because the traders who blow them are bad traders. It's because they're human traders who haven't yet built the psychological infrastructure to support consistent execution. They know the rules. They might even know exactly the 3 rules I've described today. But knowing and doing are separated by the widest psychological gap in trading. And that gap is bridged not by more knowledge, but by practice, by repetition, by the patient, unglamorous work of following your rules, even when it's uncomfortable, even when you lose, even when the story your mind tells you is very convincing. Growing a small account without blowing it isn't a dramatic achievement. It's an ordinary one, done by ordinary traders who have decided to do one extraordinary thing: trust the process more than they trust the feeling. The process is the 3 rules. Risk only what won't touch your psychology. Execute exactly as planned. Sit with the results. That's the whole architecture. Everything else is detail. The accounts that grow are not the accounts belonging to the smartest traders or the most talented ones. They belong to the traders who decided at some point to stop treating each trade like a verdict and start treating it like a data point. To stop needing to win and start needing to execute. To stop managing outcomes and start managing behavior. That shift is available to you right now. Not when you have a bigger account, not when you have more experience. Right now, with whatever is in your account, on the very next trade you take. 1 trade at a time, following 3 rules, compounding slowly, protecting your thinking first. That is how it's done. If this reached something real in you today, stay with this channel. There's more here, not more information. More of the internal work that actually changes how you trade. Subscribe not because this channel needs you to, but because you need what's here. It's built for exactly where you are. I want to go deeper into something because I think there's a dimension of the 3rd rule, result neutrality, that doesn't get explored nearly enough. And it has to do with what happens to a trader's identity when they've been following their rules consistently and losing anyway. This is one of the cruelest tests trading gives you. And I want to be honest about it. You can do everything right. You can follow all 3 rules. You can size correctly, execute as planned, and sit neutrally with each result. And you can still have a losing streak that lasts longer than feels survivable. That is a mathematical reality of any probabilistic system. Losing streaks happen to disciplined traders. They happen to profitable traders. They are not a sign that the system is broken or that you've made a mistake. They are simply what happens when a random sequence of outcomes from an edge that wins 55% of the time occasionally delivers 8 losses in a row. But here's what happens psychologically during that streak. Even to a trader who intellectually understands all of this, the losses accumulate and a question starts to form. Not the question you can articulate to another person, the quiet one, the one that whispers, maybe I'm not cut out for this. Maybe I'm the kind of person that this doesn't work for. Maybe everyone else can do it but me. That question, that soft, devastating question, is where accounts actually go to die. Not in the trades themselves, in the response to that question, because when a trader reaches that point and the question is running, the next decision is the fork. One path leads to shrinking the position size even further, reviewing the rules, reassessing the edge over the full sample, and continuing with patience. The other path leads to doubling down, to throwing the rules out because clearly they aren't working, to trying something new, something dramatic, something that might just fix everything in one move. And that path, the dramatic path, the rescue trade, the one big bet, is the exact mechanism by which a trader who has done almost everything right until that moment turns a drawdown into a blown account. The belief underneath that choice, the belief that one trade can fix everything, is the same belief I named at the very beginning of this video. It doesn't go away when you're following the rules. It waits. It waits for a losing streak. It waits for that quiet question. And then it presents itself as boldness, as courage, as trust in your instincts. But it's none of those things. It's fear. Fear wearing the costume of conviction. The way through that moment, the only way through, is to have decided in advance what you will do during a losing streak. Not to figure it out when you're in the middle of one, when your judgment is clouded and the question is running and the account is smaller than it was. You have to build the rule before you need it. What will you do after 5 consecutive losses? 6? 8? Write it down before the streak happens. Put it somewhere you'll see it. And when the streak comes, not if, when, follow the rule you made for yourself when you could still think clearly. That advanced decision, that pre-commitment, is the most important protection a small account has. Not the stop loss, not the position size. The decision you made about who you would be during the hardest moment. Because the hardest moment will come, and when it does, the trader you were during good times won't be available. You'll be the trader in the middle of a streak, and that trader needs a rule to follow that was written by a wiser version of you. Let me talk for a moment about something that nobody wants to talk about when the subject is small account growth, because it feels discouraging. The timeline is longer than you think. Growing a small account without blowing it, if you're doing it right, if you're following the rules, if you're protecting your thinking, is a slow process. Not because the math doesn't compound. It does. But because the psychological development that has to happen alongside the compounding takes time. Real time. Not weeks, months, sometimes years. I know that's not what you want to hear. I know you came into trading maybe with a timeline in your head, some number of months before this becomes a living or before the account is big enough to matter. And that timeline, wherever it came from, is probably wrong. Not because you're not capable, but because the internal work that has to accompany the technical skill can't be rushed. You can read every book and watch every video and still need the live market repetitions, the actual losses, the actual uncomfortable moments to build the psychological muscles that consistent trading requires. The traders I have watched succeed over the long-term traders who built real accounts from small beginnings and kept them almost universally share one characteristic. They got patient before they got good. They stopped fighting the timeline. They stopped needing the account to be bigger right now. They made peace with the process and let the process take as long as it takes. And paradoxically, the moment they stopped rushing, the compounding started. Because when you stop rushing, you stop taking bad trades to try to speed things up. You stop doubling positions to make up for losses. You stop holding past your target because you think the trade has more to give. You start doing exactly what the rules say, every time. And that consistency across enough trades, across enough time, is what turns a small account into a real one. That's the unglamorous truth underneath every how I grew my small account story you've ever heard. Not a secret strategy, not a perfect setup. Patience, rules, and the willingness to protect your thinking even when everything in you is screaming to do something dramatic. You have what you need to start right now. 3 rules, 3 practice steps. And the willingness to be honest with yourself about which voice is talking when the rules get hard to follow. That willingness, that particular form of courage, is the rarest thing in trading. And it is the only thing that actually matters in the end. Stay with the work. One trade at a time. There's one more thing I want to address before we close. And it's about the relationship between the 3 rules and what I'd call the gap between knowing and trusting. Because most traders who are drawn to a video like this already know, on some level, that position sizing matters. They know that following the plan matters. They know that results should be evaluated over a sample. They know all of it, and they still blow accounts. So the question isn't whether they have the knowledge. The question is why the knowledge doesn't protect them. The answer is that knowledge operates in one part of the brain and trading decisions happen in another. When you're sitting calmly at a desk reading about risk management, your prefrontal cortex is fully engaged. You're reasoning clearly. You can see the logic. You can feel how right it is. But when you're in a live trade and the position is moving against you and every second feels like another small loss, a completely different part of your brain takes over. The part that is wired to avoid pain and seek safety. And that part does not consult your knowledge. It acts. It reacts. It does what feels necessary in the moment. And what feels necessary in the moment is almost always the opposite of what your rules say. This is the whole problem. Not lack of knowledge. A gap between knowing and trusting. Trusting means something different than knowing. Knowing is intellectual. Trusting is physical. Trusting is when your body can sit in the middle of a loss and not need to do anything about it. Not because you've suppressed the discomfort, but because you've accumulated enough experience of following the rules and surviving the discomfort and eventually seeing the sample play out that your nervous system has learned, this is okay. We have been here before. We follow the rule, we survive, we continue. That nervous system learning takes time. It takes repetitions. It takes losses that you stayed with, that you didn't rescue, that you let play out according to the plan. Each one of those losses, each one where you followed the rule, even though it hurt, is a deposit into the account of trust. And at some point, that account has enough in it that the trust is there when you need it most. When the streak is running and the question is forming and the desperate part of your mind is looking for a rescue trade, the trust says, we have been here before. Follow the rule. That is what you are building. Not a trading account, though that matters. You are building a trust account. And every time you follow the 3 rules, every time you size correctly, execute as planned, and sit with the result, you are making a deposit. Small ones, one at a time. And the account that will save you when things get hard isn't the one with the dollars in it. It's the one with the trust. Take care of your thinking. The money will follow. Let me spend a few more minutes on what I think of as the hidden cost of not following these rules. Because we've talked about the obvious cost, the blown account, the lost money, the reset. But there is another cost that rarely gets named and that I believe is actually more damaging in the long run. And that is the cost to your belief in yourself as a trader. Every time you break one of these rules, every time you move the stop, every time you size too large and feel your stomach drop, every time you evaluate your system based on a single trade, you create a small piece of evidence against yourself. You add to a file that your unconscious mind is keeping, a file labeled, I don't follow my rules. And that file, as it grows, becomes the most powerful argument against your own trading. Not the market, not the system, the evidence you have been quietly collecting about your own unreliability. I've seen this destroy traders who were technically gifted, traders who could read price action beautifully, who had genuine insight into market structure, who had real edges. But they had broken their rules so many times, over so many months, that they had built an ironclad case against themselves. They didn't believe they could execute. And without that belief, they couldn't. Not because the belief was true, but because it had been made true by the accumulated evidence of broken rules. The reason the 3 rules matter for growing a small account isn't only mathematical. It isn't only risk management in the conventional sense. It's that following your rules is the only way to build the belief that you follow your rules. Every time you honor the plan, you add to a different file. A file labeled, I do what I say I'm going to do. And that file, as it grows, becomes your most powerful resource as a trader. Not your system, not your analysis, your relationship with your own word. That's why I say the rules protect your thinking first and your money second. Because a trader who believes they can follow their rules will find a way to trade profitably. A trader who has lost that belief, who has too much evidence in the other file, will struggle no matter how good their system is. The internal foundation precedes everything else. So here's how I want you to approach the next week. Not as a week of trading, as a week of rule following. Make that the mission. Not to be profitable, not to find great setups, to follow the 3 rules on every single trade you take. If you miss a good setup because you couldn't confirm it fit the rules, that's fine. If you lose money following the rules, that's fine. If the week ends in the red but every trade was executed as planned, the week was a success. because you added to the right file. And that file is the foundation everything else gets built on. When you look back at your trading in a year from now, if you're still in this, if you've done the work, the thing that will matter most isn't any particular trade or any particular strategy. It will be whether you built the discipline to follow a process day after day, through losses and streaks and uncomfortable moments and all the stories your mind told you about why this one time was different. That discipline is the achievement. The account growth is the result. And results follow discipline with enough patience and enough time. Start with the next trade. Follow the rule. File it in the right place. Do it again tomorrow. That's all mastery has ever been.